Fitch, one of the world's foremost credit rating agencies, has lowered the credit rating of the United States. That has shifted from its peak AAA level to AA+, an occurrence that had happened only once before. However, what implications will this have for the U.S. economy? Virtually all countries worldwide spend more than their income and cover the difference by resorting to debt issuance to borrow money from financial markets. Risk rating agencies assess the probability of default on these countries' debts, considering a comprehensive evaluation of their economy, where the primary factor is the fiscal health of the country in terms of its revenues, expenses, and debts to determine the likelihood of default. Taking this into account, Fitch published a report on the 1st of August explaining why it has lowered the U.S. rating from AAA to AA+, based on 5 points. According to Fitch, there has been a consistent deterioration in U.S. governance over the last 20 years. This has led to a strong division in Congress and last-minute agreements to decide on the debt ceiling. Consequently, this has caused an erosion in the trust placed in the country's fiscal management. Furthermore, Fitch asserts that the U.S. lacks a medium-term fiscal framework. In other words, it adopts a short-term approach, unlike other developed countries. These factors, combined with economic shocks in recent years, a decrease in revenue due to tax cuts, and an increase in expenditure, have contributed to consistent debt increases over the past decade. It is expected that the general government deficit will rise to 6.3% of the economy in 2023, compared to 3.7% in 2022. This reflects weak federal revenues, new spending initiatives, and a greater burden of debt interest. Despite the agreed cuts in the fiscal responsibility law, projected to result in cumulative savings of $1.5 trillion by 2033, according to the Congressional Budget Office, the short-term impact of the law will be nearly negligible, with savings of $70 billion in 2024 and $112 billion in 2025. Additionally, Fitch forecasts that the deficit will rise in 2024 and 2025 to 6.6% and 6.9% respectively, due to weak growth in 2024 and an increased debt interest burden. Addressing inflation comes with a cost. Interest rates must be raised, thus the government is paying more for the new debt it is issuing. Even though lower deficits and robust economic growth have reduced the debt-to-GDP ratio over the last 2 years from the peak of 122.3% reached in 2020, it still remains well above the 2019 level of 100.1%. And it is projected that the debt-to-GDP ratio will increase to reach 118.4% by 2025. With Fitch's longer-term projections indicating further increases, thereby increasing the vulnerability of the United States' fiscal position to future economic shocks. Over the next decade, higher interest rates and increasing debt will amplify the debt service burden, while an aging population and growing healthcare costs will escalate spending on the elderly population. The Congressional Budget Office projects that interest costs will double to 3.6% of the economy by 2033, estimates a rise in mandatory spending on Medicare and Social Security by 1.5% of the economy during the same period, and forecasts the depletion of the Social Security Trust Fund by 2033. This will pose additional fiscal challenges unless timely corrective measures are implemented. Tighter credit conditions, a decline in business investment, and a slowdown in consumption will lead the U.S. economy into a mild recession in the fourth quarter of 2023 and the first quarter of 2024, according to Fitch's projections. The agency anticipates that the real GDP growth of the U.S. will decelerate to 1.2% this year, compared to 2.1% in 2022, and an overall growth of only 0.5% in 2024. Job vacancies remain high, and the labor force participation rate is still below pre-pandemic levels, potentially negatively impacting medium-term growth potential. Despite all of this, it's important to make some clarifications. Firstly, the AA+ rating remains quite high, and the outlook is stable, and Fitch cites structural strengths of the U.S. economy such as its size, the diversity and dynamism of its business environment, and the fact that the dollar is the reserve currency as key factors for maintaining a high-quality debt. However, Fitch does provide some clarifications about events that could lead to a further deterioration of this rating. But before I share what these are, remember to subscribe to not miss out on our new content and support the channel. Fitch identifies two factors that could lead to a further downgrade of the rating. Firstly, mishandling of public finances that leads to an increase in government debt, which could include not addressing medium-term fiscal challenges in both spending and public revenues. Secondly, partial or total loss of the dollar's reserve currency status, leading to higher interest payments for government debt. Fitch also presents two factors that could lead to an improvement in the rating. Firstly, the implementation of fiscal adjustments that result in a reduction in the debt-to-economy ratio. And secondly, a reversal in the governance deterioration, leading to more consensus in addressing this issue from both the Democratic and Republican parties. And what do you think will happen with U.S. debt? Will other agencies also downgrade the rating? I'd like to know your opinion. And if you want to learn more about the possibility of the dollar losing its position as the world's primary currency, which is so important in this rating, I recommend you watch this video next.